And good morning, everybody, and welcome to the pre-market roundup. Pre-market look at what's going on. We're going to talk about a few things today. Well, it's Friday, August 21st, 2020. And I think what's really important to look at is something that's coming from you, the listeners and the watchers and the users and the subscribers about timeframes. And we're going to talk about that today in detail and really focus in on that because I've gotten a lot of questions about what time frame should I be using here? Should I be using a 30-minute? What if I'm a swing trader? Should I use a daily? What if I'm an intraday trader? Should I use minute charts? We're going to talk about some of the real important features of the Commander Series, in particular about market profile. So before we do that, I want to mention that this is for educational purposes only. It is not a recommendation nor a solicitation to buy any security of any kind. It is investing, and investing, of course, we know involves a lot of risk, and you can lose money or part of your money that you invest. So we're making sure you're very clear that we're putting this big disclaimer, this big disclosure up, that this is for educational purposes only. I don't know if I mentioned it, but I'm the co-founder of TriggerCharts. And back yesterday when we were preparing for today, I talked with Kevin about the whole idea of what's going on with some of the questions that are out there. What are you fielding? What are we talking about? I know some of the things that I've gotten in recently, some of the questions that came in through the help desk as well, I had routed back to me. And basically, it was all about the idea of intervals, time frames. What should we be using? So we're going to talk about that. Let's get into this discussion. By the way, everything that we talk about here is included with the indicators are available on the TradeStation trading app platform. And there's a 10-day free trial for all of the indicators, whether it's Commander Series, the aileron, the key reversal indicator. All these are available on TradeStation for a 10-day free trial. So you could check it out. The full versions are available there. So let me talk about what's happening here. Well, I guess the rally, let's talk about this first. Looks like it's never going to stop. And just when you start thinking that, watch out. I got to tell you, sometimes what we find is that there is I'll say that there is a complexity to the markets that takes into consider psychology. And just when everybody's on one side of the boat, you have to watch out for the other. Right now, we're seeing the futures down 100 points, not a big deal after what we've seen over the last few days. The NASDAQ is down a mere 19, seems to go up every single day. Markets in a frenzy mode. Buy the dip is definitely all over investors' minds right now in terms of what they are going to be doing. And big announcement here. Hold on to your seats. The bull market is officially over when it comes to the S&P 500, clearly the NASDAQ, and the bear market's over and the new bull market is actually starting. So this is, where you get from a bear market down of at least 20% and then renew those highs sometime in the future. This is one of the fastest times we've seen a recovery in history. Obviously, that comes on the heels of one of the fastest drops that we saw as well in history. So some of that, you have to take with a grain of salt, realizing that there was a tremendous amount of stimulus, which is fine, and it's price that pays, so it doesn't matter the reasoning and rationale behind it. So we're trying to get and make sure that you stay on the right side of the trade every single time over time. So I want to talk about timeframes. And I want to kind of talk to you a little bit, and you can kind of put some chat in the chat, ask questions and talk to me about some of this in the chat panel. The questions come up, hey, I'm an intraday trader, and I'm thinking about, well, do I want to use a 1 minute, a 5 minute, a 10 minute, a 15-minute chart, and what's the difference? Or somebody says, hey, I'm a long-term buy and hold, or at least a long-term swing trader, and I want to look for where those support points are. Should I start looking at the 30-minute, 60-minute, 240, daily, weekly? What should I be looking at to gauge where I am at? Now, one of the things that's really important, if you look to the chart to the right here, one of the things that's really important to recognize is that when we're looking at these charts, and we're looking at particularly these altimeter levels, which is an algorithm based on a market profile, or as we call it, the radar. And what happens here is that these are important levels that combine some components. It's not just simply drawing a line for support, resistance, and the midline, which you see there. You always see three lines, right? You see a red line, which is the unfair high, as we call it, or the launch. You could call it different things, but let's just call it what is called in market profile. It's an unfair high. We have the unfair low, and then we have a key volume area in the middle here. So, I mean, again, it depends on, you can call it whatever you want. So let's just, for this discussion, call this the resistance and the support, and let's call it just our midline, just for the discussion here. Because I think it's really important. This high volume node is really important. It's not always in the center. It's sometimes offset. In this altimeter, it's a little bit towards the higher end, which leads us to believe that there's higher prices within, and the ramp moving higher is within that range of movement. But there's something else that's really important, and let's get to this, because I think what we want to look at here is, and I'm going to bring this up and show you, it doesn't really matter what we look like at a particular chart here, but the radar. So actually, let's just look simply at, we're going to turn all this off. We're going to turn off the autopilot, we're going to turn off the altimeter, and we're just going to look at a chart, and we're going to look at with radars. And what is the radar? These particular indicators that we put down here include volume, every single tick that happens, every trade that goes off, there is a reference point of what price and how many shares. So in theory, if we had a tremendous amount of volume, let's say at $100 per share, and not much at 101, 102, 103, or 98, 95, but every single trade within a period of time is always at 100, you're going to have a market profile that just shows a very, very tight consolidation of color. There's going to be the density of that color and the density of the lines that are drawn around the 100, and then nothing above or below. Where you see a normal looking market profile, we'll call this daily. We could, again, look at any particular time frame, but this is semi-normal. This is kind of a big B here, but where we see the center line of the high volume node and the fattest part is in the middle, where you see kind of a D. Let's see if we can get one of those. Take a look at these. We'll say this one is, this is not the right one. Let's look at this. This one here. This is a normal. This is relatively normal. They're these big Ds. When you look at this and you could draw a shape, right? You draw this D. Where this one is not a D. You draw a B. And that's how it looks. Well, what we're doing here each and every time when we are looking at the market profile, we're looking at volume, how many shares were traded, and at what price. The more information we have to develop that, the higher the signal, the better the signal. The more information, the more accurate you can be. Now, let me compare this for a second. We're looking at daily, and I think this is important. Let's compare and contrast this. Let's compare and contrast this to, let's go crazy. Let's get down to a 1 minute. Now, you'll see there's some normal charts here, right here, but oftentimes you'll see a lot more spread of this, meaning that on a 1 minute basis, these look like they're wider ranges, but in truth, what are they? We're going from 338.60 to 337.80. That entire range right there is $1. Now, in a 1 minute chart, you may say, well, I like that. The problem is when we start adding in, for example, the altimeter, let me get there, altimeter, and let's kind of take off the radar for a second. Now, all of a sudden, our ranges are that much tighter. So now the total range on this here is from 338.57 to 338.44. That's 13 cents. That can happen in an instant. You're trading a 1 minute chart. There's not enough data generally to get a significant signal all the time. Now, you may say, well, what about over here? Let's put on the autopilot. You got a great signal right here at 338.44 to go short right there. So let's kind of mark that point. Right here was a position to go short, right? And then all the way down, you got into it and you got out down here at 338, we'll call it, 337.90. So we're talking about 338.40 approximately to 337.90. That's 50 cents. So if you're trading 1,000 shares, which would be $338,000, you just made yourself $500. If you're trading, I don't know, 20 shares, you're not making much on that range. Now you say, well, Andrew, this is a high price stock. Okay, well, let's just look at another stock that maybe isn't as high price stock and think about really what is, the potential. Let's switch over to gold, which is a little bit less, still in the hundreds. We'll go a little bit less after that. But you got to see there's a lot more signals that are developed throughout the day. And those signals right here, 182, It took you up to 180. I got to keep on going in decimals. 182.30, let's call it, on the signal to get long on a 1 minute chart at 14:10 in the afternoon, which is 2:10. And at 14:30 or 2:30, you got out at approximately right here at 182.68. So we got about 50 cents. Again, you're trading 1,000 shares to make $500. It's a $182,000 trade. Are you willing to put up $182,000 to make $500 on a 5 minute trade? Well, yeah, if it happens consistently. But you know what? You're going to be getting chopped around. There's a lot of choppiness because during the day on a 1 minute basis, you know what? We're not putting in a lot of information to give us a really high quality signal, and anything can happen on a 1 minute basis. Let's move this out to next a 5 minute. Now, 5 minute, look at this. There's a lot more range going on. So you may say, well, wait a minute. If I'm going to go on a 5 minute basis and there's a lot more range that's happening here, well, aren't I putting a lot more at risk? Yes, but here's the point. To make the same kind of money that you're possibly making before, maybe you don't have to put as much money up to risk, and that's an important feature. So right now we're looking at this signal right here where we had a short call. So it was, let's mark the time here, about 10:30 in the morning, and it moved out here at about 11:30. 1 hour trade on a 5 minute, right? 1 hour. This is the full range of the short call down to the totality of where it said to move out. So let's calculate that and let's look. So right now we're looking at, there was 186.30 down to 184.50. There was 2 points. There was 2 points you made. So instead of putting up $186,000 with $1,000, maybe put up 500 and you would make 2 points, you would have made $1,000 on half the trade. In other words, the more information that we provide into the signal, the more quality of the information in terms of volume and price that goes into developing where this is, the more accuracy we can have because basically there's not as much chop. I mean, trying to trade a 1 minute chart and getting any kind of significant money, that's, you know, a lot of people want to do that because like, well, I can't lose a lot of money doing that. The inverse is true as well. You'll probably get chopped around and not make a lot of money as well. Now, it's all up to you. You decide what you want to do and how you trade and what interval you use. As a matter of fact, let's see if I have this poll here. I think, let's see. Here we go. I'm going to throw up a poll right now. I want you to answer this question. The question is, what time frames do you prefer? And then I really want to focus in on some of this because I think we really get lost in the whole idea of risk and reward a lot of times. I'm going to focus in on this whole idea of time frames because I think it's really important to understand how market profile works and how the altimeters are formed. So again, when we go back here and we put in the altimeter and the radar inside of here. And by the way, with the radar, so when we go here, no, let's go over here. Studies. Where am I going? All right. Here. Let's see. I'm not having an easy time here. Basically, I don't know why this is not sitting here right, but here is what I'm going to do. Here's what I'm going to do. I had a little moment of not being able to figure that out. So on the radar right here, I'm showing you the settings. You can put 30, which we leave as the base, density 50. You can increase that if you want to show a little bit more, a little bit less density of the overall bars. And this 3 is number of radar. So let's make this 6. When we make it 6, you'll see what happens. It's going to draw many more radars on your chart, and you can see what's happening going back in time. But the point that I'm making here is that the more information we have inside of our calculation, the better off that we are, and the more, I would say, opportunity that you can provide yourself. So when we have, like, this was a great opportunity right here to go short at 184.66 and then pick it back up at 182, and we saw that there was really nothing happening. What kind of formation is this? Well, this is something that we like to look at. This is a little b. See little b? There's another little b here. This is a D. I would say this is an elongated D. And this, it's kind of a, I would call it a big B because we got the bottom on that. When we see these right here, the little B's, that means that there's a long-term support within the range on the bottom, but there's not a lot on the top, and meaning that you can see a very fast move vertically through time through that. And it's exactly what we saw. Clear this all up. That's exactly what we saw right here. This whole range, right? Because there was nothing here. This area, there was nothing. When we see that, it's really important to recognize those are the places to work. But again, back to intervals, and I'm going to go and we have a few more people that are going to hopefully answer the question of what's your time frame in the poll. But what I want to do is I want to switch this over. And let's take another chart we're looking at here. I want to move this over. Let's move this to 30-minute now, okay? This is a 30-minute chart. Now, in a 30-minute chart, you'll see there was some weird and wacky stuff going on. This gap down, a company called Fastly, that earnings come out. They gap down. We got some weird-looking radar going on there. Then we get some normal radars. We get a little big B here. We get, I would call a little B with an extension. Then we get a big P here because we get this move up to the top right now. Stock is trading up a little bit this morning. And then what happens is that right now on a 30-minute chart, we're at a launch point, right? Because now what I'm going to do is I'm going to look left. Say it with me in your mind. Look left. We're always looking from right to left on this to see where there's a range. And what I'm going to do here is I'm going to take a box tool. I'm going to draw over the top of this. I'm going to see that there's really not a lot going on in this range. Look, it's kind of blank. So therefore, if it does break up, and in particular, if it breaks up right over here, about 91.50 on a 30-minute chart, there's really a good opportunity for this to break up. Now, will it get back to 110? That's a different story. But what I want to show you here is, and if we take this even longer now, let's take it out to 60 minutes. The charts start looking differently. And this is maybe not the best example. Let's go back to, let's go to one of the other ones we're looking at here. You'll see that there are these spikes where you have very little data. There's not much to go on here. And what we have on these are these really nice shapes. You start to see a better density. You start to see a better look. Now, can you, in fact, trade a 30-minute chart if you're a scalp trader? I would say yes. Let's go back to SPY for that matter. Let's take a look at this. Let's clean this up a little bit. Let's take off our radar. Let's just leave it with the autopilot and the altimeter. And then this 60-minute, let's go to a 30-minute, and let's see. Now, what happened here was there was some good opportunities, but a lot of these, again, were in and outs because you bounce sideways throughout the day because you don't really find major points on a shorter-term time frame from the aspect of where the opportunities are. Now, right here, there was a good short, but a lot of these other positions, I mean, there was a long at 337, moved out at 339. The shorter you go, the less opportunity you have, the less risk you have. But I would dare say that many of you that are trading on very, very short time frames, ask yourself, have you really had a lot of significant winning trades? And I'm talking about in normal market hours. I'm not talking about after hours for a second when there's really thin trade. Even futures, when they trade overnight, they trade really thin. Is there really a significant amount of opportunity on a 1-minute chart? Somebody's asking about futures. Let's take a look at the futures. Here's the ES, okay? Now here's 30-minute. I like 30-minute. I've told you this from the beginning. 30-minute is the play that I seem to like and that I like to trade, and particularly inside of normal hours. We'll call that 8 o'clock in the morning to 5 o'clock at night or so, 6 o'clock at night, somewhere around there. Overnight, you want to trade that and be up all night, that's up to you. But let me just look at this one particular good trade right here. This is really representative of this, and somebody's asking about the short time frames for futures. This time frame on a 30-minute, it did jostle you around a little bit throughout here, but look at this. You got in at 33.88 on a short side, and you kicked out at 33.49. That is gigantic. That's a gigantic move. And then you got out right at the right time. Now let's kind of go down to a shorter time frame. Let's just kind of click it to a 15-minute. That 15-minute was probably back a little bit more, somewhere over here. You know, but you were in and out. See how it gets choppier? It does save you a little bit, but you in, out, in, out. You got most of this. Again, you would have gotten in at 33.78, which is a good cue right here. And then you got out at 33.60. You got the same thing going on, but then you got chopped around a little bit, which is fine. Under 15 minutes, I just don't see the logic. Let's go down to a 1-minute time frame. Now, there is some benefit here, but we talked about 33.65 to 33.59. That was 6 points. Futures, though, the big difference between a future and a stock and an ETF is that futures, particularly during some times of the day, have a lot more, well, they have a lot more leverage capability, of course, for the dollars that you're putting down. So if you may have made $500 on this trade on just one contract, right? 33.65 to 59, so $250 you would have made right here on this move with one contract outstanding on the S&P, which is a 50 points per move. So this is beneficial, but I still think that if you want to make the real money, I think you want to bring it up to at least maybe 15 minutes, but I really still like the 30-minute time frame, because remember something, even though you're sometimes getting whipped around on some of these moves, right? So this was a nice move, 33.80, got out somewhere. By the time it is probably 33.76, 4 points, but you would have had maybe the opportunity of getting 10 points. You're going to get whipped around here a little bit. This was an in and an out, long, it did nothing. This was early morning until the market opened right about, where the market opened? Right about here. The market opened right about here. Get whipped around a little bit, a little up, a little bit down. But the heart of the day, usually in the open, the close of the session. But a 30-minute gives you a lot more range to work with, a lot more information. And we can see this major spike that's going on right here. So you got in short right here at 33.77, got out this morning at 33.65, a 12-point gain. It looks like there seems to be, I don't know where this particular level is. It's only probably 1 or 2 bars. Oh yeah, right here. 33.67. You would have been in at 33.67. And for whatever reason, who knows who said what and what thing is coming out of the White House about or the Senate or the Congress right now. But you can see this thing is spiking. We're talking about, since we started talking about a 100-point move. Going back to our polls. I know I'm moving fast. We don't have a lot of time. Going back to our polls. Here's what everybody said. I'm going to end this polling right now. Our answer. 31% of you, the majority of you, were under 10-minute bars. Ask yourself, have you been very successful? And if so, stay with what you're doing. I can't imagine, I've been doing this a long time, making significant money with under 10-minute bars, particularly for stocks or ETFs, or maybe even to that degree, Forex. Forex, a lot of traders like the 240-minute. You're dealing with a very leveraged product, of course. The same thing with futures. The second is daily. So that's 25% of the people said that daily was what they're using. Okay, so, within a couple of points, there's a range of people that are going very significantly short-term, under 10-minute bars, to people that are going long-term. What we like to do is use a 30-minute bar for trading, for opportunities. Check it with the other different areas. And how do we do that? Well, that's the reason. That's the core, and that's the base of why we have this set up. And you have to use this with the radar screen part of the autopilot multi-time frame, where you have a 30, or whatever you set this up. This 30-minute, this is how it comes, 60-minute, 240, daily, and weekly. I want to know, what is the overriding trade? So this morning, if you came in, you're like, okay, look, the market's down, and you started to really hit hard and get significantly exposed to a short trade, you could have made some money. We saw that, right? You made some money on the downside. But one thing that we know about the SPY, or we can pull this up as the @ES if you want. It's going to look the same. And we pull up the SPY, or we pull up the futures, that there's a long alert on the weekly. Okay, so when we look about the weekly, there's a long alert here. And of course, this is because it's also going significantly 24-hour cycle, a little bit different than the SPY. If we change this to a daily, it would look the same. But we have a long alert here on a weekly, which is interesting. So we look at this time frame, we kind of click this down a weekly, and what do we got? Well, we have this really deep situation here that formed, that was in just a transition. If you would have done a weekly, would have got in at about 31.28, got out about 24.65, retired, and had a nice day, right, with these futures. But on a weekly basis, very tough to really hold on. I mean, you really have to have some cojones to get in at 29.47 and go through all the different ups and downs and the money win and money loss on a leveraged product like this on a weekly basis. So we look at that, but it's not as important. But look, we started to see that there was significant times that we started to see that the longs were producing. Right now we're in a consolidation, have to get above, we have to get 33.90 about to start seeing this turn yellow again. Right now we're trading at 33.78, so we got about 12 points. That's on the daily. Now let's go back to our 30-minute. Well, we can start thinking about getting in on a shorter term, saying, hey, we're not going to hold this overnight necessarily if I don't trade overnight, and look at this as an opportunity to trade until we start seeing that the long side is solid from a longer term perspective. Now, we know the trend since March 23rd has been up. There's no question about that, right? Nobody's denying that. For whatever the reason, however you want to fight it, for whatever the stimulus, for whatever's going on, the valuations that we talk about a lot, but the bottom line is we are in a trend up. Time frames are important, and it's really important. And again, let me just mention one other thing. The 30-minute is excuse me. The 60-minute is the second most used, and 30-minute is the next. Somebody's mentioning, do I use stops? So first of all, Robert, at 240, aileron does not show. I'm not sure. The aileron doesn't show on a 240. It's not. Is it a particular symbol that you're talking about? So this is a 240. There's the aileron right there. I don't know which one you're looking at. I think it's 240 you're talking about with this. Maybe you don't have enough time going back. You need to make sure you have enough time. So when you go into the aileron, if you have to, go to your general, go to, not aileron, excuse me. When you go into your stock, make sure you have at least, you gotta edit your stock and make sure you have at least 200 days going backwards, approximately 200 bars, excuse me. Control R. Yeah, yeah, because I think what happens is that when you did this, it may not have enough days in here. So it may not be enough days. So what you want to do is data, edit symbol, and in this thing, since it's only 30 days back, we need at least, I don't know, it's bars back. We can put 200. Let's see if that works. So you need at least 200 bars. So that's the important part is 200. Maybe that's what's happening with the 240 that you're defaulting all the way to 30 days back. So we have to have at least 200 bars to calculate the aileron. The other question was, do I use stops and how much? Essentially, when we're looking at these charts, the stops are built in, right? Now, it all depends on your particular level of risk and desire for profit. But if we're looking at this, for example, let me find a good area that this shows this. Okay, so here, well, that's not a good example. Let's find a good example. I really want to find a good one for you. Basically, here's a good one. I think a good one here. Okay, so this is a good one. This when you get in right here, when this goes long alert right here, unless there is a new altimeter, which happened to be the case here, if you go below your entry point, you're going to be pulled out. That's first of all. That's kind of the stop to begin with. If you don't reach a new plateau of a new altimeter that's being drawn or a new radar. So there will be automatic, I would talk about, oh good, Robert, it worked for you. It would be a really good way to understand that we're going to pull you out if you close below. So let's take a look at this area right here. If you close below, it didn't close below, but if you close below, right at that level, you would have been pulled out there. You would have seen an orange bar that would have formed. So as soon as you go below this level of the entry level, you'd be pulled out. Now, depending on how you got in, here's an alert. You would have gotten in either here. Some people are aggressive and do it on that bar or the next bar. You would have gotten in somewhere around here, 313.70 or so. And if it did go below, you kind of get pulled out below about you'd be in right here, 314. 314.50. You've been pulled out right about at 313.50. So that would have been the case if you would have gotten out. So it doesn't let you really go below the level, give or take, of entry, depending on where that entry happened and how high above it was and what the trend is. So the stops will be kind of tight, and you see that orange happening. It'd be like the equivalent of what this happened here and how this got there. So hopefully you understand a little bit more about timeframes. Understanding that volume is an important point of all this. The more time frame you have, the more bars that you have, the more opportunity you have to push in more volume. That volume is the fingerprint of where traders are trading. It's the line in the sand of where they say, hey, I'm putting my money to work or I'm not putting my money to work. And when you look at this and you focus on and think about that market profile is all based on that equation of volume and how we calculate utilizing each and every ticket, each and every sell, and buy on that and push that in a 1 minute time period. Particularly for a stock, there may not be that much volume, particularly on stocks that have low volume. You want to use a longer time frame to push more volume into the calculation to give you a much higher level of overall confidence when you're trading. So I think that's the important feature that you need to look at, and I hope that that helped today. We're going to see you again next week. Make sure to go over to TriggerCharts.com. It will have all the information and replays of this session. So thanks for joining me this week, and I really appreciate you being here. See you again next week.